Yeah.
Money never sleeps, pal. Just made 800,000 Hong Kong gold. It's been wired to you.
Play with it. You done good, but you gotta keep doing good. I showed you how the game works. Now school's out. Mr. Gecko, I'm there for you 110%.
No. You don't understand. I want to be surprised.
Astonish me, pal. New info. I don't care where or how you get it. Just get it.
What up, guys? Welcome back for another weekly market recap. It is Saturday afternoon, technically, and I'm gonna tell you right away, this recap, it's probably gonna be a little bit all over the place with not a particular well thought out structure because it is just a reflection of my week. It was a little bit of a strange week. I've been out of home a bit more than usual. At the same time, it's particularly hot now where I do live. The warm, it's really skyrocketing. We are really going shy of 39 degrees Celsius, of course. So, the warm, it's getting to my head. I got trouble sleeping sometimes, and I constantly feel tired, debilitated, and my willingness of doing whatever, it's a bit, again, all over the place, no pun. It was a strange week, FOMC week, interest rates decision, Powell press conference. We're going to touch a little bit on that later on in the video, I guess. Then we got a shortened trading week because of Juneteenth festivity, so bank holiday. And then, of course, Friday, there was the day after a bank holiday and just before the weekend, so, not a lot. Plus, on Friday, we got the triple witches, so one of the biggest at least, options expiration on record. I guess it must be due to all these guys now starting to trading zero DTE options, which, hey, it's all legit. I mean, you do you. I guess Wall Street is more than glad to sell you new products if they can make it for a fee and therefore for a profit. So I'm going to tell you what it's going to be. We're going to look at some charts first, and then we are gonna check I mean, a little bit of a recap of the FOMC press conference. It's not huge. I mean, there was there was only a tiny portion which really caught my attention. All of the rest, it was the usual Powell stuff. I mean, it's been like that for 9 months now, maybe a year. So nothing particularly surprising there. All right. So that's how it's gonna be. All right. If you want to stay and keep watching, just be aware you are doing it at your own risk. All right. So let's jump in. Let's open up TradingView right away, and let's start out by checking the currencies. So the Chinese yuan and all the other, I mean, pretty much all the other BRICS currencies plus the Australian dollar. Nothing new. I mean, as we were looking at last week, they are all keep on doing what they were already doing before. So again, the Brazilian real showing strength. The Indian rupee now is showing a little bit of an accentuated weakness. Um, Nothing really new in the South African rand. If not, could this be the start of a topping formation, kind of like what we had in the Indian rupee? Maybe, we'll see. The Russian ruble, it's just drifting to the upside. And the Australian dollar, among the major currencies, I mean, it tried multiple times to get back above this level, and it looks like eventually it's rolling over and failing. So we'll see. As for the other majors, the euro had a little bit of a started step at resistance once again. Same for the pound. The the dollar Canadian actually traded pretty well. You remember we were looking at this level back in time, this apex right here, and that's basically where we were kind of expecting a little bit of a started step, if not some sort of a pullback. Well, it looks like we got that pullback and we tested into the apex base to the T. If you zoom back out, or should I say backward, right? Yeah. You see that's the apex and that's the reaction that it provided. The Swiss franc, it's still drifting to the upside. We didn't have any type of a bearish break of structure for now. And again, it ties in a little bit with what we hinted at last week, the interest rates differential, which, overall, yeah, it is a dynamic which is at play, but it might be in the very short term, it can see some divergences. I'm just saying it because if you didn't notice, the Swiss central bank, it's basically at zero as for the interest rate set up by the central bank. And they're talking about going negative, while, in the US, they want to keep rates where they are still. So, in between 0 and 4.3% on Fed funds in the US, there is a huge delta. So you would assume that interest rates differential should see the Swiss franc dropping and, at least against the dollar, right? Doesn't happen. At least not yet. Could happen into the future, maybe, right? But for now, it's not. And again, I think there is more to read into it as for the flight to safety, as we were saying last week. Now, let's have a look at the dollar, right? Or again, the DXY. I know the dollar, it's not really the technical term for this index, but anyway, we kept on drifting to the downside last week, and we finally got a little bit of a bounce. Now, it looks like it was faded, or at least, it just faced initial resistance, and it was expected, right? But we bounced off of a deviation out of the macro range, which again, to me, is always nice to see these relationships playing out. I quite honestly, I don't really know what's going to be next for the DXY. I think again, it was 2 weeks ago, right? When I said I'm a little bit on the watch for a potential surprise to the upside. Now, it didn't come yet, but that doesn't mean that I stopped, right, being on the watch for it. Now, there is another interesting thing that I'm looking at. It's a breaking correlation, right? So as you well know, the DXY, for the majority of it, it's made up by the euro and the Japanese yen. So normally, if you see the DXY making lower highs and lower lows, you would expect the others, right, to, like the euro in this case, to make higher highs and higher lows. So in between these and these, that is a good relationship, right? Then why the yen, which is still a good chunk of the DXY, it's not making higher highs? There is this little bit of a divergence in here. Now, I don't know. I'm just noticing. It doesn't mean that I necessarily have the answer, but could this be that something in Japan it's not quite all right? Maybe it could. On the other hand, you could also read it like, well, if the Japanese yen it's not spiking to the upside, that kind of keeps us safe from an eventual unwind in the carry trade, right? But again, just something which I thought it was worth noticing. So as for the DXY, again, the reason why I keep on being a little bit skeptical on this theme that you see on the internet, like the debt, the deficit, the dollar, it's gonna plunge. Maybe, maybe not. I'm just saying, I'm looking at it, I'm looking at the sentiment, and then I'm looking at a few tiny little things as for the DXY. Let's check some slides just for the sake of it, all right? So let's start out with this, all right? So, first of all, what you see, it's basically, if you get back to the '08 financial crisis, the DXY, it's still climbing to the upside. All right. Now, these fluctuations on a macro scale, so the dollar going up, going down, coming back up, those are normal, right? At the end of it, currencies, they do tend to move in ranges. Could be daily ranges, weekly ranges, monthly ranges, yearly ranges, right? But that's how they are designed to operate because more often than not, they are manipulated and controlled by the government or the central bank, which is the legit ruler of the currency. And all of that is done to basically balance out potential imbalances in the, I'm going to say it again, in the trade balance. I hope you get it. But basically, if you got some imbalances in your trades and maybe your currency it's getting too strong or too weak and against another, in order to balance out those trade relationships, whether you want to take them back to normal or increase them or facilitate them or cut them, you can influence your currency. So therefore, you're going to influence the balance of trade with whatever other nation you're looking at, all right? Or, if you're doing it against the dollar, it could be toward the rest of the world, right? So everyone is looking at this chart saying the dollar or the DXY, it's massively bearish. It's going to plunge. It's going to get back below 90, below 80 and whatever. Now, you might look at the price of the dollar relative to other fiat currencies, but that really doesn't tell you the whole story about the dollar keep on being the reserve currency. Actually, if the dollar goes down relative to other fiat, that just incentivate the current system to keep on existing. All right? Because if everyone it's basically financing themselves and taking on debt and then leveraging up using the euro dollar system and therefore the dollar denomination, the only way you would need to to witness in order to have a massive disruption in this system and having everyone getting away from the dollar because it's not more sustainable at this point, it's by the DXY spiking to the upside, like it happened when we got the Bretton. No, it wasn't the Bretton Woods. It was the Plaza Hotel Accord back in the days, right? So if you see the DXY actually going down, that just procrastinates the current structure of the system because servicing that dollar denominated debt, it's easier if the dollar is going down against your local currency, right? So that would be one thing which could defeat the narrative or de-dollarization, right? De-dollarization actually would happen if you got something like these, all right? Now, getting a little bit into the short-term dynamics, so on a daily time frame like this, still looking at the dollar index, we are noticing that we are massively deviated to the downside. Now, in this chart, if you zoom in, they are using two sets of Bollinger Bands with two different settings just to highlight the current deviations and the current amount of volatility in the underlying asset. Then they're using the 200-day simple moving average. And what they're doing is they are kind of highlighting the momentum as for the general trend for this market at the current moment in time, which would suggest we are oversold, right? And then they're looking at the deviation or the distance of current price action compared to the 200 days moving average. And if you zoom in, it looks like we are particularly deviated to the downside. We are pretty far from it, right? That is the distance, right? It doesn't happen so often, and every time it happened in the past, what you've seen is a substantial rally, an automatic rally into the DXY. On top of it, you just look at the sentiment, and then you could zoom out on a weekly time frame, for instance, and what you see, it's again on a momentum base. We are pretty much oversold, and we are deviated out from long-term moving averages. Because again, if you check the 200 days, it's basically this orange dotted moving average in here. You see the dollar or the DXY, it tends to trade away from it, and then it mean reverts. It trades away from it, in this case to the downside, and it mean reverts. Away, crosses it, goes deviated to the other direction, and it mean reverts. So again, we are looking at a level of deviation which you don't see so often, right? So that when you look at the technicals beyond the fundamentals and beyond what could happen in the next decade or two, it's as I was saying with oil, and then we've seen what happened with oil even before the Israeli-Iran thing. When you got these massive imbalances, that's usually the point when you where you need to start to look for opportunities by being a contrarian, in my view. Okay, then you got the positioning, right? So at least standing to Bank of America, it looks like we are reaching into decent level of short positioning on the dollar. So again, nobody wants it. A lot of people are either dumping it, being underexposed, and being short the dollar. So again, that expresses a very bearish view on it. So my point would be, I'm still on the watch for this rally because I know when conditions tend to get so extreme, usually you got something different coming against the general consensus, right? And then again, still keep on being on the dollar train wreck. Let's have a look at some facts, all right? Now look, 5 reasons, right, why the dollar's death narrative is overstated. I'm not going to read through it all, but I guess you could just screenshot that if you want, or you can just pause the video and have a look at it. It's not groundbreaking for me. I'm always be a supporter of a lot of these theses or a lot of the points which are highlighted in here, and therefore I'm not particularly worried for the dollar to lose reserve currency status in my lifetime. Dare I say it, right? So again, just have a look, see if there is something which rings a bell with you, or maybe something you never considered before, right? And if you move again, stepping back to the yield or interest rates differential, right? Again, it can have a few divergences in the short term, but if you try to apply this logic right here, it's not really against the dollar to keep on depreciating against other fiat, right? So you start to put a lot of things on top of each other, right? The technicals, the sentiment, the positioning, the fundamentals, the narratives, which at the end of it, we do know narratives, they all tend to fail, or they all tend to shift to basically the opposite when price action is shifting, right? It's like sentiment. People don't get all of a sudden bearish or bullish. People tend to be bearish when the market keeps on going down, and people tend to keep on being bullish when the market is going up. That is just normal psychology, right? And then to close this tangent, the problem is always your psychology at the end of it. Uh, Selling bearishness, it gets you clicks. It's a very powerful type of trigger for the human brain because we are just wired up that way. We tend to put more focus on what could be the existential risk than not, and we tend to discard all the other factors which could actually invalidate our doom and gloom thesis. All right. So again, it's just a psychological factor. And then in the modern society, where information can travel at the speed of light, of course, you got the bearish narrative, which is always more rational. You got the media, which are always amplifying the negativity. I mean, have you pulled up a news channel recently? Let's say in the last 5 years, what are they talking about? Murders, right? So people killed, uh, train accident, car accidents, plane accidents, war, the pandemic, the economy which is bad, inflation too high, people losing their jobs, the decay of the Western civilization. When when was the last time that you turned on the TV and everything was rosy? I'm gonna tell you, unless you're watching uh, the gentleman, the chairman Powell press conferences, that's the only type of content where you can find rosy forward-looking expectations and situations. Other than that, the only Goldilocks you find, it's in there. All the rest, it's the constant doom and gloom because it sells. Fear sells, right? And don't forget, most of the people, even in the internet space, like podcasts and something like that, they always tend to scare you out of something because they want to sell you something else. The dollar is gonna die. You should buy gold. All right, Mr. Mr. Guest, what do you do for a living? Well, I do run a gold fund. Oh, okay, that makes sense now. All right. So just be careful with it. Now let's move on to Bitcoin. So as for Bitcoin, I'm a little bit on the neutral side as for Bitcoin right now. Like, it's not really going anywhere like many other markets for now, but I'm still looking at it and thinking the same way I was thinking of it 2 or 3 weeks ago. My point of invalidation to open up the floodgates for more downside would be still this level right here. It's been tested multiple times. The last test was particularly sharp and we failed the rally. So after that, the let's call it the backup plan was unless if the rally fades and we violate this level, okay, now we are bearish up to down to the mid 90s. If instead we can still hold the level, we might just look at a new dealing range being established. So again, up until the point we are in this range now, so in between these level, let me do something because I just figured out I'm so fucking dumb that it took me like 7 years to figure out that you can use something like this to highlight your pointer on the charts so that people can actually see it, right? Okay, so neutral up until the point we get a resolution. So either we crack this level to the downside or we can close above this level to the upside and keep on, maintaining a bullish posture. I don't have a strong opinion on whether of the two will happen first. You know, you might say maybe the downside just because right now we are much closer to the downside point of invalidation. Maybe, but we were pretty close to it even in here, right? And then you've seen what happened. So again, up until the point you don't have the confirmation, just I guess hold your horses, right? Let's have a look at gold. Gold had a bearish week, which it's a little bit of a headline news these days, right? It doesn't happen so often, right? But yeah, bearish week. Is it bad? Well, I wouldn't say so. At least for now, we just uh, rejected new highs. We came back down into support. We are hovering around it for now, still maintaining it, kind of like it was in here. So again, up until the point a level breaks, you can't. I mean, you can't really start to short gold like there is no tomorrow in here. I guess at least I wouldn't. That is just because I don't short supports, right? Up until the point that broken and flipped to resistance, and you have an actual shift in the trend or in the volume flows, right? So again, after a week where nothing really happened or nothing substantial happened, I would say even gold for now, I'm maintaining the same type of stand I had last week and the week prior to that. So neutrals slightly bullish, all right? So, the fundamentals for gold are not really changed in my view. Um, Look, if you thought like I did, I'm raising my hand and saying I did thought this way, and this is why I bought into gold. But if you think that one of the main reasons why gold is catching a bit is because most of central banks all around the globe are trying to diversifying from the US dollar because we have seen what went on with the Russian assets, right, which were confiscated and whatnot. Or maybe you think that with the new president, the US has now gone rogue and you want to diversify. So what you're going to do? Instead of, having all your reserves in US treasuries, which can be confiscated, you might want to shift a little bit of them into gold, which is no one's liability, right? And still, since it is denominated and traded in USD, it still serves the purpose of being a reserve asset. You got a liquidity issue, you need cash, you liquidate your gold, and you got what? Dollars, which can then be used to, I don't know, saving your unfunded liabilities or keep back your balance sheet into balance if it is out of balance because you might have some assets which are going down, god forbid a credit event or something like that, where you need to liquidate an entire portion of your balance sheet, right? You can still have gold as an insurance policy. I don't think that logic has changed for now. If anything, I think it's actually stronger than ever because now you are hearing rumors about the US getting into an open conflict against Iran to support Israel. Now, again, before you start thinking that I'm trying to send a message or another, I don't know. As I said last week, I don't know what's going to happen. I'm no geopolitical or military strategy analyst or expert, so I don't know. And as I said last week, I can only give you my individual opinion, which, by applying a little bit of a common sense, for my very low skills and my low education on the matter, I I wouldn't intervene if I was the US, because I mean, if I was Trump, should I say? Because if what they say is true, that Israel already compromised a good chunk of the Iranian military capacity, why would you feel the need to intervene? Um, yeah, because you are the only one which that actually is in possess of that big big beautiful bomb, which can what was that, the bunker buster bomb, right? And you are the only one which is in possess of the bombers which could actually deliver it, if you want to get rid of the Iranian nuclear program. Yeah, okay. Many different narratives and many different speculations, and again, most of it is driven by political biases. So I don't really know. I would just say, from a political standpoint, why would you step in if you promise that you want to take the US out of all the foreigner wars which are not your own? On the other hand, you also said that you were going to take care of the deficit, and then after just 3 4 months, basically the deficit is going to increase because there's no way to cure it. So everything can happen, I guess, right? So that would be my take on it. Now, should we have a look, since we are touching into the topic, should we have a look at oil? Yeah, let's have a look at oil real quick. Let's check these oils. So oil last week ended up by touching into this point of release, which, I'm sure if you zoom in on a 4-hour chart, something similar, like let's try and do it. Does it correspond to some sort of an apex base? Yeah, kind of. Yeah, you see this level right here. It's like a base which was broken. And then if you go out on the daily, it's just the origin of the impulse to the downside on the daily time frame. So we reacted to it. We traded back to where, look, this is interesting in my view. Now this pocket of inefficient price delivery, right? So in my view, or at least the way I look at price action, that is usually an already balanced out type of dealing range. If you remember the long setup that I described as for the 30 years bond futures 3 weeks ago, I guess, I was talking about a balanced price range. Okay, so it was traded inefficiently to the upside and then again inefficiently to the downside. So there is no more inefficient price delivery to be rebalanced. Okay, so when something like that happened, you would expect the area now to provide resistance. It's kind of like it's forming an apex on its own. All right. So what happens when a resistance, like in this case, it's cleanly broken to the upside? Well, you do expect some sort of a support resistance flip or something like it. So what you see, if you pay attention to these dotted levels right here, we broke through, we came back down, we retested it, and we bounced once again. And again, it's much more evident if you look at it like this, zooming in. So breakthrough, retested it, bounced. Now, will the bounce be sustained? I don't know. I mean, it depends on how things are going to shape up in the Middle East, I would guess. Um, Look, it's kind of like when we were talking about the stock market. I think, at the end of it, the price of oil could skyrocket if the conflict is exacerbate, right? God forbid the Iranian they want to close the Strait of Hormuz or whatever. You got an actual attack on oil production sites. in Iran. The rest of the OPEC Plus members, they already announced they are going to ramp up production now. So even there, it's a little bit of a question mark. Like if we lose Iranian oil supply, are we going to have a situation where the oil supply is constrained, or maybe the other members of the OPEC Plus will make up for it and they will keep on providing the oil to the global market? But then again, even if they want, if for some reason the Strait of Hormuz gets to be closed down, then it doesn't matter. Also, it doesn't matter, like, and this is not just valid for oil, but it's valid for basically everything which is transitioning or traveling through that piece of sea. It's not it's not really about should we close it or not. But when you think about insurance costs, right? Because every ship which travels through, shipments, they need to be insured, right? So if there is a higher risk now that for some reason your ship could be, you know, sunk or taken down by a rocket, the insurance company it's gonna demand a higher premium. And two things may happen. If the company, the exporter, right, needs to pay a higher premium for insurance, he will need to, you know, raise the price of his services to cover these insurance costs. And again, it's going to be reflected to the other person down the supply chain. And eventually, it's going to be reflected on consumers. So that could generate, in and of itself, price increases, right? So there are many different things which could spook the markets if oil, if it keeps on going higher. But even if it stays in this range, but you got other dynamics in the supply chain logistics and costs involved, which could really bring a little bit of a spike in inflation. Now, again, as I said last week, I don't think, even if that happens, I don't think it could be sustained in the sense that our, consumers, not only in the US, but globally, are they set up to endure another inflation spike? I think they're not, nor in the US, and let alone in Europe. So, you know, God forbid we got another inflation or an energy spike, right? But, I just think that could be the final nail in the coffin of the global economy right now. Um, I I think there are, as for the DXY we were looking at before, there are many different narratives going around with this war, as it should be, right? It's normal that people talk about it. But let's have a look at some charts. Now, before we go ahead, that doesn't mean that just because in the past XYZ happened, this time around it's going to be the same, but it's just to provide a little bit of context, all right? And possibly to dig a little bit deeper in what could happen and assess the risk and the probabilities of something happening over something else, right? Let's start out with this. Now, if you go out to Carson Research, they put together this tiny little list of major events, right, which impacted the stock market. Now, I know we are not talking about the stock market, but we are talking about the price of oil potentially influencing inflation, therefore influencing the Fed behavior as for the rate cuts or the policy tight, loose, and therefore the reaction that the stock market could have to these events all down the chain, right? But let's have a look at these. There are many different events back to the 40s, if you believe that. And it gives you basically what the stock market returns were for the following month, 3 months, 6 months, 12 months. Now, of course, Germany invade France. We are talking the beginning of World War II, so obviously wasn't a very good moment to be in stocks, maybe. But again, you could just pause the video and read it for yourself, or take a screenshot if you want to read it at a later stage. What at the end of it, you could filter out some things, right? If you get to most recent times, let's say after the 70s, right? Let's have a look at the Iraq invasion of Kuwait. It was in the 90s. We got a recession after that, an oil spike and a recession. All right. We got a stock market crash in 87. All right. But it was a crash. And after 1 month, the market was up 8%. Okay. Although the crash was, a flash crash, it was substantial, right? Now, let's have a look at another thing. The 9/11, okay, 2001. So there was this, you must remember, I don't need to explain what happened on 9/11, but the stock market, of course, it took the hit initially, but then after just 1 month, there wasn't really anything particularly bad. Now, after 12 months, sure, we were down, but the dot-com bubble just exploded. So was it because of the attacks, or was it because that was just a normal business cycle and we were headed through a balance sheet recession, right? Which would have happened no matter what. Okay. Then what we got, okay, the Lehman collapse, it's not really tied up to conflicts, but yeah, it was the great financial crisis in '08. I want to look for something which is related to conflicts. Oh, the US pulling out of Afghanistan? Not really. But Russia annexed Crimea in 2014. The market really didn't give a shit about it. So again, the narratives about the war, conflicts, and whatnot. Yeah, I mean, the market will figure out. And usually, when it comes down to conflicts, the market is pretty sharp and pretty quick in figuring out the implications and the geographical scope of the conflict, so the escalation toward other neighbor countries and whatnot, so the dimension of the conflict itself. What I would really pay attention to would be the end results, right? So the average and the median. Now again, my as I said many times in the past, my math skills are pretty low, but I do know the difference in between an average and a median. And in between the two, when you need to assess huge data sets, I will always pick the median by the simple fact that the median tends to smooth out the end result by excluding outliers, right? If you know how a median actually works. If the number of the data you input in it's even, you take the two in the middle, you sum it up, and then you divide it by two. If the number of the data set you're looking at, it's uneven, so it could be 7, 13, 21, 33, you just take the value in the middle of the series. And that's it. That's your median. So it gets rid of outliers and out of scale type of data points, right? So I would pick this one. And if you check that out, you see that at the end of it, markets in general, risk on assets, they tend to discount these major events and keep on doing what they were doing before. So again, is it a massive problem for the markets if we got conflicts right now in the Middle East? Historically, no. Will this time be the same? Possibly, although, there's always the counter argument for it. All right. Now, here you can see a visual representation of what previous conflicts actually, the impact of them on the equity market, and you can just make up your own mind. Always remember the context, right? You need to pair up those conflicts and the moment in time when they occurred with the underlying conditions of the economy itself at that time. Okay. Otherwise, you're just looking at a data point in isolation, which is not good. Now, since we got data for it, let's check out what was the reaction of the price of oil in the recent events or the recent, let's call it arguments in between Israel and Iran. Now, I know the first one is Hamas, but supposedly Hamas is financed by Iran, so there should be some sort of a proxy agent of Iran to attack Israel. And again, you oftentimes hear me saying supposedly, allegedly. Well, this is just because those are informations that you can find for free and public available information. So, I mean, you never know, right? That there is always this argument in between. Are the informations reliable? So therefore, I don't want to give out the impression that I know for sure. Okay, but anyway, we can't deny there was some sort of again, quote unquote, argument in between the two factions, and these are the reaction of the oil market to those previous events. Now, it is true sometimes you might see a tiny spike, especially the first week, but at least so far, after a decent amount of time, it could be 1 month, 3 months, you see that oil at the end of it, if you check the orange vertical lines, oil eventually didn't always roll back and kept on going lower. Uh, could it be different this time? Maybe it can always be different, but it's just you need again to see if there is a fundamental reason for the supply of oil to be constrained and therefore price to skyrocket. And then the second and third order effects, like is the economy ready to take on those price increases or not? Okay, so I guess at the end of it, what you are trying to assess is this. So more often than not, we do live in the first and second standard deviation. So what you hear on the news, most likely, and it goes for oil, it goes for World War III, it goes for the dollar, it goes for the debt, it goes for whatever, right? More often than not, those scary things you're feeding up to are really tail hand risks with very, very low probabilities of actually unfolding themselves, right? So that would conclude this brief parenthesis of oil. Now, what happened instead to yields? A bunch of nothing, I'd say, right? So nothing really moved yields a lot, and therefore, conversely, even bonds they didn't move a lot. I mean, if you zoom out on a weekly time frame, well, you could almost say that it was some sort of a positive week for the bonds, right? I mean, the long end didn't really go anywhere, nor the medium end. The short end, so the 2 year note, yeah, maybe a tiny bit, maybe, but it's not really substantial, right? So I wouldn't have a lot to say on the bond market for this week, at the very least. We'll see next week. I think I remember there are many different treasury auctions next week, so we'll see. Now remember, there is an interesting dynamic at play when we get to these auctions, which is many different market participants, they tend to short the bonds and therefore to drive the yield higher, the asset lower, so they can then scoop up these bonds at the auction at a lower price, or they can make sure that when they buy them up, they can grant themselves a higher yield, right? It's just temporary, but it tends to happen, right? It is just again, you could call it market manipulation, right? If you ever read that book from the biography, basically the story of Jesse Livermore, Reminiscences of the Stock Market Operator, there is a chapter in the book where he's talking to another guy, and they are all basically operating in the stock market, and they clearly talk about market manipulation, right? It could be selling into a bounce to see if the other side of the trade is really buying with conviction, right? Or it could be driving the market to a specific point in order to be able to then buy or sell at the price level you would prefer to engage with. Okay, so wouldn't be, in my view, wouldn't be surprising if next week you see bonds or yields in this case having a little bit of a spike to the upside throughout those auctions. And then at the end of it, I think for the most part it could be just noise, and the real again, the direction or trend for the short to medium term will be set up in the coming weeks and months. Okay, so I wouldn't really, unless you got some, for real this time, failed auctions not the one when we got the US debt downgraded and that famous 20 years auction gone badly. Not that type of bad auctions, but real bad auctions. All right. So if you are into bonds, you could you could follow how they go, right? I'm not, quite honestly. I think I'm just gonna look at the end result at the end of the week. But as for the rest, I won't. So let's have a look at the stock market. So we left the index futures, right? So the AS mini, the NQ mini, and the Dow futures last week saying, look, we got a few highs and a few lows, actually two highs and one low, which were put in throughout the overnight session. And they might be weak, therefore vulnerable. So the market could decide to go and take them out. So let's have a look next week at how the week opens up and see what the intentions of the market are for this week. And then we can establish if we can target the high or the low or whatever. So we started out, this is the weekly open, we immediately rejected the lows, right? And we started rallying throughout Monday. Monday was a completely upside day. We pulled back on Tuesday, as you can see in here, right? It was a little bit of a consolidation really on Tuesday. Toward the end of the day, we dropped like a lot, but didn't really break anything substantial for the overall structure of the market. And then we got another push down right in here, and we finally took that week low. And I just forgot that on Monday, right away, we took out that week high. So the first highlighted, right? It was this one and this one. So we took it out both on ES and Q. I don't know about the Dow because the Dow it's just there to be a little bit of an arbinger when I'm undecided in between ES and NQ. But on the major two, we did it. So we took out the week highs and then the week lows. Perfect. Then what we got after taking out the lows, same as when we took out the highs, right? We immediately pulled back and mean reverted. Same as we took out the lows, we mean reverted to the upside. So at the end of it, nothing really happened because you need to take into account that Thursday basically it was a little bit more of an extended overnight trading session because of the festivity for Juneteenth. And again, so you can categorize these low as a week low now. There should be a week high as well, if I'm not mistaken. Probably. No, I don't think there is. Maybe this low could be relevant, but as for the rest, I mean, again, I'm not a profile trader per se, but it's bouncing up to my ass just a week low for now. So it was interesting the way we basically pulled back on Friday, I guess, because we just pumped straight out from the open. And it was interesting to see that ES didn't take the previous daily high. NQ actually did. The Dow didn't. And while, ES and the Dow were failing at new highs for the day, NQ was succeeding. And then you got a little bit of this tiny little thing right here. So you got ES making equal highs, NQ making lower highs, the Dow making higher highs. Yeah, I mean, it's a 1 minute chart. I know it. You might say, okay, so what? Well, I mean, it produced a good pullback at the end of it. So a little bit of an exhaustion while we are witnessing a break in correlation on a larger time frame like the daily or the hourly time frame, and then since price is fractal, in between those high time frames and the lower ones, you're seeing a breaking correlation even on the lower ones. And it just so happened that you got this tiny little shift where NQ basically came out to be weaker a little bit and originated a dump. If it sounds like all bullshit to you, yeah, okay, fine. I guess it's It's all well and good, but I'm just telling you, it is it is something that you might want to pay attention to, right? Because at the end of it, you could basically profit from it. If we have a look at these, that is basically NQ futures trading above the daily highs and then breaking back down. Now, this image right here doesn't really make justice to it, but was nice. 70 points move. Uh, NQ futures, they move, the increment is $20 per point, so 70 points per $20 per two contracts. Not a bad trade in my book. If you want to appreciate that a bit better, I'd say let's try to change the screen. Never did it. Let's see if I can. Turns out I can. So it's a bit clearer right here, right? So yeah, on the 1 minute chart, you see NQ going up, taking out the overnight high right here, pushing through R3 as for the pivots for the daily, and immediately being rejected, right? At the same time, do you see your momentum oscillator starting to roll over from a higher read? And again, if you check this is a tick chart. If you're not familiar, it's a bit different, but still, it still represents price action. You were also having a little bit of an exhaustion because we were overbought, and we started to exhibiting delta volume divergences while we were breaking through the highs right in here. So as soon as it mean reverts, as you've seen, up until the point, it pumps, it's already diverging. So the volumes on the buy side are getting weaker. You are overbought. Then you see a retest the overnight high, bounce. The bounce is faded. We get back below it, and then you short. You get back below the overnight high and the R3 level as for the pivot. This one right here. Okay. Uh, that yeah was a good trade. I mean, we it's not like you can always fade these things, but the context was there, and then we got the pivots suggesting that given they were particularly wide, so that would have been suggested mean reversion. You tend to have a bit more of a trending day when these pivots are really tied up. Doesn't always happen, but yeah, more often than not, it's a good sign. Now let me get back to the other screen at this point. Let's see if I can do that. Looks like I can. All right, so let's close it down. We don't need to look at at things, and probably maybe 3 or 4 people in the audience would be able to understand. So, but since we were there, why not? What else? Well, at the end of it, the market kept on hovering around the lows, and we just ended up the week like this. Now, if we zoom out, what we see is that basically the market in general, all of them, they just went nowhere. If you zoom out on a weekly time frame, yeah, but just like not a lot. You keep on seeing the Dow and the Russell, they are a bit on the weaker side relative to the Nasdaq and the S&P, but there's really not a lot that I'm seeing right here. Um, yeah, we are still bouncing off of these moving averages. They are still upside sloped. The faster are above these lower. So there is no shift in momentum. And again, you might say, okay, but the RSI is giving you divergences. The stochastics is trending to the downside. The MACD, it's pointing down. Right. All good observations. I would just say to it, you know what? If you see your oscillators actually trending down, while at the same time price action, it's just consolidating and going sideways, you could take it as a bullish reset. So we are wearing off the overbought condition, and if the oscillators at a point turns to the upside, while price action didn't suffer a lot of damages, well, you're more bullish than ever. Okay. Now we did also took into account the possibility of a drawdown in the S&P or in in markets in general. I remember I said, you know what, with the buybacks going away starting in the middle of June, so we are losing a big bidder for these markets. With this little bit of uncertainty as for the conflict in the Middle East, the price of oil, inflation, and now we got Powell saying he's not cutting and probably he's not going to cut in July either. So we, wouldn't be atrocious to see the market pulling back a bit, to like 3-4%, right? Would it be catastrophic? No, I think no. So again, even in this market, I don't see any particular reason to change my view. Still uh, neutral, slightly bullishly bias oriented up until the point we didn't start to crack these moving averages and we start to break the structure in a meaningful way. And especially what I would like to see, it would be a sharp move which breaks like a clean break uh, with volume potentially. So at that point you might say, okay, maybe something changed in here, right? But up until the point I don't see it, right? It's just there is the infinite bit, okay? And you could even get back to what Mike Green says, the giant mindless robot, right? The passive investing, the passive funds, and every time a dollar gets in, it's splitted by market capitalization. So you always see the big caps, so the Mag 7 keep on going up and sustaining the market higher. So again, I don't see an immediate danger for downside in the technicals right here. Then again, as I was hinting at in the beginning, your your bias always changes when price action is changing. So again, you might change it upon confirmation, but up until the point, I guess you shouldn't. All right. So that would be it for the charts, right? So let's instead have a look at what was the the more fundamental part of the week, which was so a little bit of data and of course the big Kahuna J Powell and what did he say? All right.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So And what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost. But ultimately, the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming. And we just want to see a little bit of that before we make judgments prematurely.
follow up on that. So you spent years there talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If you know, at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Yeah, I know. I'm always too harsh with good old Jay Powell. And to his credit, like I did in the past, I gave him credit for it. I mean, I don't know if it's his own or maybe just the economy on itself. But, he didn't break things. Like, I remember I'm on the record saying, yeah, if Powell keeps on hiking rates, he's going to cause a recession. Well, did it? Some folks would say in 2022 we actually got a very mild and sharp recession, but the NBR says it's not. So for the record, he didn't cause a recession. So again, it was right then, right? I'm still thinking they are really taking a chance as usual of getting late to the party. Like, they were late when they needed to hike rates. And then they were wrong saying inflation was transitory. Although, again, there is another point of debate, because if you intend transitory, like in the common meaning of the man of the street, he hears transitory and he thinks about maybe a few weeks, a few months. In macro terms, transitory could be 2-3 years, right? So again, eventually inflation started to come back down. He paused, and then he caught 100 basis points. Ironically, the yield curve just went up 100 basis points conversely. So, look, beside the slides in the recap, in the short recap we have just seen for the labor market, I think, even if you check the economic calendar for this week we just ended, highlighting the main focus on what came up. Like you see the United States New York Empire State Manufacturing Index, it's not in a good shape, right? So again, manufacturing for now, not cool. Like, I guess October, November 2024, on the euphoria for the elections and the promises, it ticked up a little bit and then it completely rolled over, right? So at least for now, it doesn't mean that it couldn't change in the future with Trump policies, but for now, not seeing it. This was a nice one. U.S. retail sales. Now, look, in the past, I've always been particularly skeptical and critic about this data point because it's not adjusted for inflation, okay? And when you adjust it for inflation, what you see is that these data series right here vastly overestimate the retail sales in real terms. There is one thing to say now, though. Although I've read a few articles which were highlighting the fact that this was a huge miss, right? It came in at negative, almost 1%, and it was expected, a bit higher than that, and especially compared to the previous read, it was particularly negative. Now there is one through. I don't know if you could really call it truth in the real term but of the word, but let's put it this way. Do you remember we talked about the front running of tariffs, right? When we were talking at the GDP Now Fed calculator, right? So that goes for the retail sales as well. Look, they basically started to pick up in March, and then they came back down after tariffs were imposed. Now, that creates a discrepancy in the data set. I'm going to tell you what it is. Look at this, for instance. If you have something like this happening, what was the main driver which dragged the retail sales so low for this release? It was motor vehicle and parts. And why is that? Well, because one of the main worries when Trump implemented tariffs were the tariffs which were going to impact the auto and automobile sector. So if you were thinking about buying a new car, would you have waited, or would you have bought it right away before potentially tariffs could have inflated the price of it? So again, there was a huge run in auto motor vehicles and auto parts, front running the tariffs right here, April, March, right? And then we're just seeing we're looking at the give back period of that exuberance, right? So again, it's not as terrible as the headline would suggest, okay? And especially when you start to think that many different things are not factoring in the control group. Okay, so as you can read in here, for instance, these three categories, right? The motor vehicles, what was the one? Gas station, building materials, those are all excluded from the control group. And if you exclude them, which supposedly would have been the ones which have seen the most front running for fear of the tariffs and the tariff inflation, right? If you exclude them, the control group actually increased, not 0.4. So again, it's always a matter of digging into the data and analyzing them, and then make up your own mind. Like, I do think, all in all, despite this punctualization right here, I still think this is not a particularly good trend. Okay, let's say you get rid of this blip, right? The front running and then the payback. Still, since July 2024, imagine you get rid of this spike because we didn't have the front run, because we didn't have the tariffs. It was still going on a downward trajectory for me. So yeah, it creates distortions, right? You can't just ignore them, right? It's not like you can erase a piece of the chart, right? But just take it in the context under which it deserved to be taken, right? Then what? Industrial production, it fell, and it's falling since basically December 2024. Yeah, a little bit of a blip in here, but if you look at the year-over-year read, where was it? This one right here, annualized. Again, November 2024 elections, everybody euphoric, bring back manufacturing, and then it's rolling over now. The Philadelphia Fed Manufacturing Index, it's now below the end of 2024 levels. I mean, it dipped below and it came back up a little bit, but it looks weak. Then what you got? Well, I almost never touch on the housing market, but if you look at the building permits, downward trajectory even in here, peaked in 2022 and it was down ever since. Housing starts. This is not screaming higher, right? Than what we got. Oh, this was interesting, and why I'm bringing that up. I mean, it came up this week, so it's in the data. But I bring it up because of this, because I'm looking around and I'm seeing these titles. Stealth QE is real. Stealth QE is real. Okay, because they, again, they say something which is true technically. The Fed is still buying up treasuries, right? The problem is if you actually look at the definitions, right? What is QT? It's a taper of the balance sheet. Now, how do you taper it? It's not like you are willingly dumping treasuries on the open market. You are just letting those that you own get to expiration. And poof, they're gone, they're vanished. So now the problem might be, let's say, very simple example, I got a balance sheet of 100 treasuries, all right? I'm saying I want to taper my balance sheet by, I don't know, 2 treasuries per month. So every month I'm going to make so that instead of 100, next month I'm going to have 98. Next month I'm going to have 96. So what happens, all right, if this month, let's say the first month, the actual number of treasuries which are getting to expiration, it's not 2, which would bring me from 100 down to 98, but it is, let's say, maybe 5, in order to maintain my established ratio of tapering. I need to buy up 3 treasuries to make up the difference, and maintaining that, you know, down step by two, month over month. So again, the definition of QT, it's tightening the balance sheet, which is already and still happening. But in order to maintain the pace at which this balance sheet, this taper should be tapered, they need to compensate the amount of treasuries which are actually falling off the balance sheet because they are expiring. But it's not like they're doing QE in the strict meaning of the term and they're just running up the balance sheet. Okay? Because the same thing which people are claiming right now, I'm sure as hell it was happening 2018. I didn't hear, I mean, maybe, but maybe it wasn't so vocal, but I didn't hear people screaming about stealth QE or back in the days it was what, Operation Twist. I mean, every time the Fed does something, and I don't like the Fed as an institution. I think central banks are useless, but at least when they're actually doing something, which they said that they will do, I mean, just give them credit for it. They said it, they are doing it, and they're doing it at the exact pace they promised to do that. Okay, just a little bit of a technicality, but it always gets to me. Okay. Again, inflation. So inflation is basically at 2.4%, standing to the official numbers, still trending down. Want an independent opinion on this? So Trueflation, it's telling you now 2.17%. So below the establishment read. The break-evens are not massively pointing to the upside. So again, inflation expectations, they don't seem to be unanchored, as Jay Powell likes to say. And I know if you look at the Michigan, University of Michigan type of inflation expectation survey, it might seem different, but we discussed last week how corrupted that data could be, and for the political affiliations and whatnot, all right, and the way they poses the question. So again, get back to it if you don't remember it. Then look, this is interesting, right? It looks like every time the Fed actually went for a cutting cycle, we always fell into a recession, at least over the last 40 years, more or less, right? Now, why didn't I include the 70s? Well, look, it's not cherry picking the data. I was just wanna first take a look at something which is more recent and therefore closer to the way the central banks are conducting monetary policy now compared to what they were doing in the 70s. Just to name one, in the 70s, they weren't targeting a specific Fed funds range. If you go back to the Paul Volcker era, yeah, they were targeting a range. It was 4% wide. Now they are targeting a 0.25% type of range with Fed funds. All right. So and even before that they were managing reserves instead of actually targeting an interest rate range. So the way they were conducting monetary policy, it was a little bit different. So I think it would be disingenuous to compare apple to oranges. All right. But look, every time they went for a cutting cycle, sooner or later we fell into a recession. And as I noted in the past, is always in red the 2 years yield, which is leading Fed funds. You see, Fed funds is always lagging both to the downside and to the upside, which begs the question: why doesn't the Fed just target the 2 years yield, right? Just to say one. Now you might say, okay, but look, in the middle of the 90s, they cut and we didn't have a recession. That is true. They achieved this soft landing Although, there is one tiny little thing. If you go on these magical website, long-term trends, you have access to all the basic spreads for the yield curve. What is missing in the middle of the 90s? Let's have a look. 95, 96. So this period right here. Does the 10-year and the 1-year yield looks inverted to you? Nope. Does the 10 and 2s look inverted? Nope. The 10 and the 3 months, was it inverted? Nope. The 2-year and the 1-year? Nope. So basically, the main parts of the yield curve, it wasn't inverted. Oh, it's plural, so they weren't inverted. So we didn't have a recession because the market wasn't pricing in a recession. Okay. And what about, talking about raising rates, lowering rates, holding rates where they are, the risk associated with inflation, tariffs, inflation. Okay, there is always one place from which inflation can be generated, which is the amount of money present and most importantly circulating in the economy. Does it look to you like M2 money supply, it's skyrocketing to the upside? Yeah, it contracted like a lot. Now it bounced a little bit, but you're not seeing it like this, like you were looking at in this period right here after the pandemic. So again, I think the risk of inflation by monetary dynamics, it's not so huge at the current moment in time, I think it's dwarfed by many other different downside risks. So I would lean on the side that maybe it's time that even the Fed, like any other central bank in the world, would join the cutting gang and starting to cut. Currently, the CME Fed Watch tool, even for July, they're pricing in almost a 90% chance they won't cut. I don't know if they won't cut. Again, it's too early. Let's have a look at this tool maybe 2 weeks down the road and then we'll see. I think, at the end of it, many different things would point to the fact that we need to cut. The Jay Powell, he doesn't want to for whatever reason. Now, to be fair, if you check the credit spreads, they're still kind of tight, so there is not an immediate credit event risk, right? And again, if you want to check credit spread, instead of going onto the Fred database and type every single different tranche of corporate credit instruments, you could then again hop in to long-term trends, and they got a bunch of different credit spreads, taking a look at the BAA, AAA. I think this is an aggregate of B's and A's against corporate bonds. Oh no, this is just the B and the A compared to each other, I guess. Yep. So I mean, many different things. The mortgages, so mortgages rates against U.S. Treasury bonds. So many different things you can find if you are a nerd in macro-related topics. And so ending up what we got. Oh well, I just posted a screenshot of these last week. I inserted it because I forgot to mention in real time. But the Strategic Petroleum Reserve are particularly low right now compared to where they were in 2021-22, where we got the spike in inflation. So again, if you're looking for a reason for a potential spike in inflation, this could be one, because if oil spikes now, the president doesn't have the ability, at least he doesn't have it to the same degree Biden has it, right? Or had it, to draw down the Strategic Petroleum Reserve, flooding the market with oil and therefore taming the price. This time around, it looks like that possibility it's a little bit out of reach. So oil could be free to spike. But again, if it spikes, it creates so much destruction, so much demand destruction that I don't know how could the economy possibly resist to it. Okay. And this is the calendar for next week to end up everything else. So as I said, there should be a few bill auctions next week, as you can see. The the star of the week for next week should be PCE, I guess. We should also have the Flash PMI, but I usually don't pay much attention to them. Although, I mean, I'm not saying you shouldn't look at them, but yeah, not my favorite. Ah, GDP as well. Okay, quarter over quarter. So, we might have some things. Oh, the trade balance. Yeah. It might be so in between GDP, PCE, the trade balance. It could be a very volatile week, even next week. So just be ready for it, all right? And then we end up with what? The Michigan Consumer Sentiment, and this is the final release. So we got, when was it? Last week or 2 weeks ago, the preliminary, and now we got the final. So again, inflation expectations. So a lot of different things. Next week it might be volatile as well. With all that said, I started out saying it would have been all over the place. I guess the only thing I achieved is making it unbearably long. So I'm gonna leave you off at this point, wishing you a very nice weekend, a very nice rest of the weekend, a very nice Sunday, and we will see what next week will bring up. Up until that point, as usual, be nice and be cool. Nils out.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry. And no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.